Where's Frank? This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so it's been fairly slow in the news, so I figure we're going to dive a little deeper into some areas that we've talked about recently, and we're going to talk about risk assessment. I know you're saying, oh, Brad, not risk assessment again. I really think this is so important, and you'll understand why in a couple seconds, that we need to talk about it more, and we'll probably, unfortunately, talk about it in future episodes too, and we're going to dive into one particular aspect of it. So risk assessment and understanding assertions. Now remember, SAS 145, which is understanding risk, or the risk assessment process as part of the audit, is effective for calendar audits 2023. This is why I'm really harping on this over and over and over, is if you have a calendar year audit, you're going to have to do a lot deeper dive into the risk assessment aspect. And for those that are in industry, don't turn this off, because you need to know that when we as auditors are asking you a lot more questions about the IT process, technology. We're asking you more questions about the internal control process. This is the reason why. If we start asking you questions we never asked you before about risks and uncertain areas, this is the reason why. So, assertions. Understand the assertions. What are assertions? So the definition that I found is assertions. Financial statement assertions are claims made by an organization's management. So the assertions are management's responsibility. So for those that are in the industry thinking, I don't want to hear about this, you need to know when we start going over financial statement assertions, they're actually assertions that you're making within your financial statements, or claims that you're making within your financial statements. The assertions form a theoretical basis from which external auditors develop a set of audit procedures. Whew, it all sounds really good. Okay, Brad, are we done? Nope, we're not done, because we have to hit that 10-minute mark, so we're going to probably be able to cover that. There's generally 7 assertion areas. Some say a little bit more, some say a little bit less, but I'll give you the assertion areas that we as auditors generally focus on. Existence and occurrence. That's companies' assets or liabilities exist at a given date and recorded transactions have occurred. Completeness. All transactions and accounts and disclosures that have been presented in the financial statements that should be presented in the financial statements are included. And we'll explain these more through some examples in a little bit. Valuation or allocation. Asset, liability, equity, revenue, expense components have been included in the financial statements at the appropriate amounts. Rights and obligations. The company holds or controls the rights of the assets and liabilities or obligations of the company at a given date. Presentation and disclosures. Financial statement components are properly classified and described and disclosed. And the last one that I like to put in there, if you read certain documents, they don't have it in there, but I like to make sure it's in there. Cutoff. Transactions have been compiled into the correct reporting period. So those are generally the assertions that we focus on when we're assessing risk. Now we're going to talk about some other aspects that kind of fold into this too, but I want to talk about assertions because if Frank was here, miss him, if he was here, he would say, and I've seen in the past, when we're doing peer reviews, this is one area that people are very weak on at assessing risk by the proper assertion. I was doing a peer review one time. Now, if you know, we have our own internal design practice aids, and there's third-party practice aids where you assess the risk. Now, in the past, you didn't used to do it by account area. Now they tell you you're supposed to be doing it by assertion for all accounts. So you look at the assertions. Now, you take cash, you should be considering all these assertions. Considering as part of your risk assessment process. Take accounts receivable and sales, same thing. Considering every separate assertion for these areas. I was in the middle of doing peer review for inherent risk. The peer reviewee assessed inherent risk for every account, every assertion, medium the whole way down. As soon as I saw that, I said, A, they really didn't think about this, or B, they really don't understand the assertion aspects. And when I sat down with them, it was a constant struggle to try and get through the process. And you could tell that the person really didn't put the time and effort in to think about it. Inherent and control risks, you're supposed to consider inherent and control risks at the assertion level too, when you're doing the risk assessment process. Now usually what we see more often than not, control risk is assessed at high, because we're not going to test the controls for its effectiveness. Now, I'm saying that, but there's people that are on here, some people that do nonprofit audits that are testing controls. You have people at some of the bigger firms that are testing controls. You have internal auditors that are testing controls. But I was just giving you the general comment that I see at a lot of medium and smaller firms for a lot of common audits. One of the areas that I see as a problem, and you could tell that there's an issue that people aren't understanding, assessing risk at the assertion level, is cash. You're saying cash? What could be a problem with cash? Well, one of the items that you have to consider assessing is valuation. Cash in and of itself, let's just talk about it, for most instances, should either be low for valuation, low risk, or non-relevant. Because if a dollar is not worth a dollar, if that's not the value, I think we're having a lot of other issues, probably within the United States itself. Okay, so when I saw that at that particular peer review, I asked them, I said, well, unless you have cash that's in foreign accounts. And he said, oh, I do. I'm like, oh, I'm sorry. I guess I understand that you could be assessed differently. I said, where are those foreign accounts on your trial balance? I don't see them. Oh, they're with investments. I said, well, then it's not part of cash, that's part of investments. So you really need to be going into these and thinking about them a lot deeper. Another example that I'll see is revenue, assessing revenue and the inherent risk. Now, a lot of times now remember, revenue in and of itself is a presumptive mandatory fraud risk. So that makes it higher right there. But what is the risk of revenue? All too often I'll see people put existence of revenue. Now, if you have point of sale, we have supermarkets as clients. The fact that you made a sale in May, you've collected the money, or even doesn't have to be a supermarket, it could be a warehouse, a distributor. The fact that they made the sale, they collected the money, I don't think there's a lot of risk there. Usually the risk that we're concerned about is the cutoff. Did they record it in the proper period? Now, I also have technology clients. Technology clients usually have a lot of deferred revenue. There I have existence issues. There I could have classification issues. So you see, you really have to put a lot more thought into it than to just say high, low, or medium for whatever assertion it is. Some contradicting assessments that I've seen are particularly between existence and completeness. Somebody will say existence is high and completeness is high. Well, existence says what's on the books may or may not exist. And completeness says what exists may or may not be on the books. How can they both be high? How can you say that they recorded stuff that wasn't there and, oh, they didn't record stuff that was there? And I asked somebody one time and they said, no, it's possible with this client. I said, well, it sounds to me like we have a material weakness in internal controls. That's another aspect to consider. And he said, no, their controls are really weak. I said, well, can I see the letter, the AU-265 letter that says that they have a material weakness? Oh, we didn't give them one. I said, well, how can you not give them one? You're saying right here in your risk assessment that they're really bad at addressing their assertions. So these are the concepts and the ways you have to kind of think about them and go through them. I'll give you some quick examples. I'm watching the time. I'll give you some quick examples of poor directional testing. Now, directional testing is you're saying, here's the assertion and here's the risk and how am I going to test it? So verifying accounts receivable balance, that's existence. You want to make sure that those receivables exist. Some people only trace to subsequent receipts. Well, subsequent receipts addresses valuation. That doesn't attest existence as of a given date. Fixed assets are potentially overstated. That's an existence issue. However, the audit procedures focus on repairs and maintenance. Well, if you look at repair and maintenance, you're saying, hey, something could have been a fixed asset and it's not properly recorded. That's a completeness issue. So you have to know the test you're performing and if it's directionally proper to the risk that you've assessed. Another one real quick, accounts payable may be understated. You're saying accounts payable could be understated. I don't think that it's complete. Whatever's out there in the world is not complete in my general ledger. So what do a lot of people do? They go and they vouch accounts payable invoices. Well, that's not addressing the issue. That's addressing existence. So the directional risk, again, focuses the procedures you're performing to the assertion that you're citing. We're going through this in a 10-minute snippet area. This is something that gets a little bit deeper, but I wanted to spend some time specifically. When Frank and I have talked about 145, we've just kind of gone over this pretty quick. The other area I'll just say real quick that they're bringing up now is something called SCADA beads. You probably have heard me make fun of that word, SCADA beads. Okay, I think it's part of the Queen Bohemian Rhapsody song, SCADA beads, SCADA beads. SCADA beads stands for Significant Class of Transactions, Account Balances, and Disclosure. So you first look at that, and then you look at the assertions underneath. So the SCADA beads is something new that's kind of being introduced and being required to be considered as part of the new risk assessment process. The last thing I'll say, and then we'll wrap it up, who is doing the risk assessment? A lot of times we just give that risk assessment to the youngest person on the team, and they don't know anything about either the client, the industry, auditing, sometimes even accounting. You shouldn't just dump it to them and have them do it. You want to work with them, ride alongside of them and have it so you can explain it to them, but I wouldn't just give it to the younger person to do. Okay, I know I went through a topic really fast, but I just wanted to kind of bring that up just so you get some thoughts going and get the thoughts percolating in your head. But, if you'd like to learn more about the risk assessments, the NJCPA is offering some webinars. Assessing the risk of fraud in financial statement audit is on December 4th. And the new risk assessment standard with Renee Rampula is on December 13th. Register at njcpa.org/events. And lastly, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/group. Thank you for watching or listening.